My name is Jim Weisel, Professor of Accountancy at Georgia Gwinnett College. In this video, I'm going to demonstrate a comprehensive lease problem, a business case for Home Visions. Home Visions is attempting to lease some equipment and they need to make some decisions about what sort of lease agreement is going to be the best for them. And so we're going to explore the possible options. What I recommend that you do with this video is print out the PDF file that's associated with this case, and then you can follow along with the calculations as we make them. So let's get started. So Home Visions is negotiating to lease some manufacturing equipment from Becker Leasing. We have all the particulars identified here with respect to two possible options. One is a 7-year lease and one is a 3-year lease. And we can see that there are different cash flows associated with the two options. And so Home Visions is trying to determine what their best option is going to be. In order to do that, we need to know and understand which of these options or how these options would be accounted for. In other words, is option 1 an operating or capital lease? And is option number 2 an operating or capital lease? So that's what we need to evaluate. We're going to take the terms and conditions of the two options and go through our analysis of answering those 4 questions for each of these options. Is there a bargain purchase option? Does title transfer? How does the lease term compare to the expected useful life? Does the lease term meet that 75% criteria? And does the present value of the future lease payments meet the 90% criteria of fair market value? So what I'm going to ask you to do here is to hit pause and answer those 4 questions for both of these options, option 1 and option 2. So I want you to go through the calculations and try to determine on your own whether the first option is an operating or capital lease, and then do the same thing for the second option. Determine whether it is an operating or capital lease. Once you've done that, then you can hit play again, and we'll compare your solution to what I've come up with. Okay, so hopefully you have gone through the process of determining which option is an operating lease or which one is a capital lease. And I'm going to skip to slide 3 here for a second. We've got some requirements for the problem, but we know what we need to do. We need to evaluate whether the options are operating or capital leases, and then we'll go ahead and do the recognition, and then we'll talk about the financial statement disclosure, and then lastly we'll do a little bit of analysis, again from a managerial standpoint, which one of these two options is the best for Home Visions. Okay, so here's what I came up with in terms of answering the questions. So option number 1, that's the 7-year lease option. First of all, there is no mention of transferring of any title for either one of these. There's no mention of a bargain purchase option. In fact, there's no mention of an option to buy the asset at the end of the lease term at all. And option number 1 is a 7-year lease. The estimated useful life of this equipment that we are potentially renting or leasing is 10 years. So the lease term of 7 out of 10 is only 70%, and so option number 1 does not meet that 75% test. And then finally, we have the present value of the lease payments, and we need to evaluate whether the present value of the lease payments is 90% or more of the fair market value. So let me bring up my financial calculator here, and we'll plug in the terms of the potential lease option. First thing is payments are being made at the beginning of the year. If you have the problem in front of you, you see that we're evaluating potentially starting this lease on January 1st, 2015, and the lease payment, the first lease payment, will be due at that time. That makes this a beginning of the period sort of situation. The payment, each payment for this 7-year lease is expected to be $160,000. So each payment we are plug in as a negative $160,000. The discount rate associated with this lease option is 7.5%. There are 7 periods associated with this lease, and they are annual. So my calculator here, my online calculator, set up a little bit differently than your Texas Instrument calculator, but it's all the same input factors. Beginning of the period payments I have selected, payments of $160,000 each. Annual interest rate is 7.5%, and then there are 7 annual periods, and so I calculate the present value, and the present value turns out to be just over $911,000. $911,015 is the present value. The question is that 90% or more of the fair market value of the asset? And we can see that it is, in fact, more than 90%. It's 91%. So 911,000 out of $1 million fair market value is 91%. That means that we answer yes to this particular criteria. So option number 1 is a capital lease. We've answered yes to at least one of the 4 criteria that need to be addressed. Option number 2, we go through the same process. Again, option number 2, there's no mention of title transferring. There's no bargain purchase option. The lease term is for 3 years out of a 10-year useful life. That's only 30% of the expected useful life. So option number 2 does not meet the criteria for a capital lease. And then we need to evaluate the present value of the lease payments. So let me bring my calculator back in here. I'm going to reset it. Again, payments are expected to occur at the beginning of each year. Here the payments are estimated to be $180,000. So it's a shorter term lease, but the cash flow is a little bit more. Other than that, the terms are pretty similar. Interest rate is 7.5%. There are 3 annual payments to be made, and so I need to then determine the present value. And it turns out that the present value is just over $503,000, $503,202. And so that's only about 50% of the fair market value. And so that clearly does not meet the 90% test. So option number 2 is an operating lease. So now we know that option number 1, if we were to agree to that, to those terms, that would be accounted for as a capital lease. And then option number 2, we know if we agree to those terms, that would be accounted for as an operating lease. So that addresses all of the measurement issues that are needed for this particular lease analysis. And now we can move on to the recognition. What we're going to do is first deal with the recognition and financial statement disclosure associated with option number 1. How do we account for a capital lease? So I'll move on to the next slide here. And we need to determine how we're going to recognize this. Once again, what I want you to do is hit pause in between each one of these journal entries. See if you can do the journal entry on your own first, and then continue on with the video and compare your solution to what I'm talking about here. Okay, so the first thing to do is to record the initial recognition of the lease on January 1st. Since we have already determined the net present value of the future cash flows, remember that the general rule is that for a capital lease, we record the lease at the lesser of the present value of the future cash flows or the fair market value. We determined earlier that the present value is $911,000 some odd dollars. Fair market value is $1 million. So we will use the $911,015 to recognize the initial lease. We debit assets under a lease or leased assets, something along those orders, and then a lease liability or a lease payable of $911,015. That's what happens on January 1st. The second journal entry that happens on January 1st is that we recognize our first lease payment. Now, since the first lease payment is also occurring on January 1st, there's no interest expense associated with this. Remember that we followed the usual pattern of taking the book value of the liability, multiply it by the appropriate interest rate, and multiply it by the portion of a year for which the liability has been outstanding. Well, at this point, the liability has been outstanding for 0 out of 12 months, and so the entire $160,000 of lease payment goes to reducing the lease liability. And so that also occurs on January 1st. So now what we need to do next is to deal with the fiscal year end adjusting journal entries. Hit pause again and record your adjusting journal entries. You're going to need one for interest expense, and then you're going to need one for depreciation. Once you've completed those journal entries, come back and follow along. Okay, so on December 31st, we need to recognize our interest expense for the period, and so we're going to follow the usual pattern of determining how much interest expense we have. So let me bring a calculator in here, and we'll go through the steps. The lease liability started out with a balance of $911,015. I've made one payment on that lease liability of $160,000, and so the balance in the lease liability account is now $751,015. The interest rate is 7.5%, so I multiply that by 0.075, and then I can multiply that by 12 twelfths. From January 1st to December 31st, 2015 is a full year, and so I have $56,326 of interest expense to recognize this year. Even though I'm not going to make the payment until tomorrow, January 1st, 2016, remember that I have an adjusting journal entry here to deal with the interest expense that needs to be recognized. Now, the way that comes out in form of a journal entry is I simply have to record the $56,000 of interest expense and record the interest payable of $56,326. Again, that'll be paid tomorrow. The other adjusting journal entry that typically goes along with assets under lease is depreciation. Remember that the substance of the transaction is that I'm going to account for this as if I had purchased it. So even though it's technically assets under lease, I have the financial impact, or I have to reflect the financial impact as if I had purchased this asset. And so assets under lease are depreciated just like if I owned assets. So once again, I'm going to bring up my calculator here and figure out what my depreciation is. So I've got an asset with a $911,015 basis, and the useful life to me, the lease term, is 7 years, and the problem indicates, or home vision indicates, that we use straight line method of depreciation. And so I will divide that cost basis by 7 to determine that my depreciation expense for the year is $130,145. And so depreciation expense gets debited for $130,145. Accumulated depreciation gets credited for $130,145. That's all of the recognition that goes along with option number 1. Next step then is to do the financial statement disclosure. What I want you to do once again here is hit pause and see if you can get to the financial statement disclosure. Remember that what we're focused on here is the balance sheet, And so you have a couple of things to make sure that you get reflected on the balance sheet. But whatever you do on the balance sheet is based on these journal entries and these journal entries alone. This is what happened in 2015, and so our balance sheet needs to reflect what happened in 2015. Okay, so now that you've done the balance sheet disclosure, let's see what I've come up with and compare your solution. All right, so what we have here is on the asset side of the balance sheet, we have assets under lease with a net balance of $780,870. That's simply the cost basis minus the accumulated depreciation. On the liability side, we have interest payable. That was recorded on December 31st, 2015. So we have interest payable of $56,326. And then we have a total lease liability of $751,015. That's the total lease liability. Now, technically, that total lease liability should be split up between the current portion and the non-current portion. Remember, this is December 31st, 2015, and so we are going to make our next payment tomorrow, January 1st, 2016. And so technically, we need to figure out how much of that $160,000 payment is going to go towards satisfying the lease liability. We have actually already done the calculations necessary to figure that out. Of the $160,000 that we're going to pay, $56,000 of that is going to go to satisfying interest payable. Remember, we just accrued interest payable and interest expense yesterday, December 31st, and so the $160,000 payment that comes up on January 1st, of that, $56,000 will go to satisfying that interest payable. The rest of it then goes to satisfying the lease liability. The portion of that 2016 payment that goes to reducing the lease liability then becomes the current portion of the lease liability. Would be listed as a current liability, and then the remaining component of the $751,000 is the long-term or non-current portion of the lease liability. Most important is that you recognize that in fact the total balance of the lease liability is $751,000. And then, since we've already done the interest expense calculation, we did that on December 31st, you can take the difference between the January 1st payment and the interest payable, and that difference is the current portion of the lease liability. Now, this gets a little bit more complex if you have more than one payment a year. In this particular problem, we've got annual payments. If we had semi-annual payments or quarterly payments, then we would have to go through 2 or 4 interest calculations in order to figure out the current portion of the lease liability. Okay, so that's the disclosure for option number 1. So we've gone through measurement, recognition, and disclosure for option number 1. We also need to go through the measurement, recognition, and disclosure for option number 2. Now, the measurement portion we've already done. We figured out that the present value was only $511,000, and so option number 2 is strictly a operating lease. So what I want you to do here is hit pause again and see if you can determine the journal entries, the recognition that's necessary for an operating lease, and then also the balance sheet disclosure on December 31st for an operating lease. Okay, so hopefully you have determined the recognition and disclosure requirements for an operating lease. Let's see what you came up with. And it is very, very simple for an operating lease. January 1st, 2015, when we record or accept the terms of option number 2, we make our first lease payment of $180,000, and we simply debit lease or rent expense. That's it. There's no asset to record. There's no liability to record. There's no interest expense to record. None of that is associated with an operating lease. An operating lease is very straightforward. Every time we make a cash payment, we debit lease or rent expense. As a result, there's nothing to disclose on the balance sheet. We didn't record a liability. There's no lease liability. There's no asset that we recorded, so there's nothing to disclose on the balance sheet as a result of this particular lease arrangement. That's why these are sometimes referred to as off-balance sheet financing, because we have the use of an asset for 3 years. We're paying for the use of that asset, but it doesn't appear on the balance sheet. And that's where the phrase off-balance sheet financing comes from. All right, so that's all of the measurement, recognition, and disclosure issues that are related to the two options. The last requirement in this problem is to assess which one of these two options has the higher pre-tax income. In other words, from an income statement standpoint, which one of these two options is going to be best. And we're just going to look at the first year, 2015. So what that question has to do with is what expenses are recognized, or what's the difference in the expenses that are recognized between the two options. Once again, hit pause and see if you can determine which option is going to result in a higher pre-tax income. Okay, so hopefully you have figured out which option is going to result in a higher pre-tax income. Let's see what you came up with. So option number 1 has interest expense recorded of $56,300 and some odd dollars. And there's also depreciation expense of $130,000. Remember, expense accounts are the ones that show up on the income statement. Not the lease liability, not the asset, not cash. The only things that show up on the income statement are revenues and expenses. As it relates to this particular lease, we have interest expense of $56,000, depreciation expense of $130,000, and that's a operating expense deduction of $186,471. Option number 2, the only expense associated with option number 2 is the lease payment itself of $180,000. That means that option number 2 has less expense deduction, and therefore option number 2 would result in a higher pre-tax income. So if we have management that is interested in managing or is concerned with the amount of income that's going to be recognized, in this particular case, option number 2 would have an improved picture of income because it has less expenses recorded. On the other hand, some management is going to be more interested in cash flow. Now, the cash flow option, there's a couple of things going on here. One is that option number 2 is the higher cash outflow, right? $180,000 compared to $160,000 each year. So option number 2 has a higher amount of cash outflow. So management may be concerned with that, in particular if they are tight on cash and they don't have a lot of excess cash laying around. So that's an issue. From a financial accounting and reporting standpoint, and we haven't talked about this before, so I'm just going to throw it out there. From a cash flow statement standpoint, you have to understand where the cash flows appear in the cash flow statement. Now, we'll get to details of the cash flow statement later on in the semester, but just understand that the cash payment for option number 2, the $180,000, that would come entirely out of operating cash flows or operating activities. For a capital lease, the cash outflows are part of financing activities because, again, we have in fact financed the purchase, or we're accounting for this operation or this lease as if we had purchased it. So the $160,000 would actually come out of financing activities rather than operating activities. So those are just a couple of things to keep in mind. But remember, the question that was asked was which one of these two options generates the highest pre-tax income, and that would be option number 2, the operating lease in this particular case. It's not always going to be the operating lease. Then the very last thing that I want to mention here is from, again, a managerial standpoint. Remember, we haven't signed any of these lease agreements yet. And if you recall, option number 1, there was no bargain purchase option. There was no title transfer. It did not meet the 75% of estimated useful life criteria. The original terms did meet that 90% criteria. And so a legitimate question to ask is, what's the maximum payment that we could accept? Remember, we're trying to negotiate this lease agreement. So if management really wants to keep this thing off the books, make use of this off-balance sheet financing concept, clearly the $160,000 of annual payments will end up, the present value of those will end up meeting the 90% criteria. So the question is, what's the maximum amount of lease payments by which we could avoid meeting that requirement? And so what I want you to do again here is hit pause, get your financial calculator out, and now the search is not for the present value of the cash flows. Instead, we're going to target 90% of fair market value and figure out what those cash flows would have to be. Once you've hit pause, done your calculation, we'll come back and we'll see if you can come up with the same $158,000. Okay, so what do we need to do to answer this question? Reset my calculator. Again, present value is going to be computed based on a beginning of the period analysis. And my target here is to have the present value no more than 90% of fair market value. Fair market value is $1 million. 90% of that is $900,000. So I don't want the present value of my payments to be any more than $900,000. Interest rate again is 7.5% per year. I've got 7 annual periods. And now what I'm trying to figure out is the payment. What would the maximum amount of payment be? And that turns out to be $158,065. And that's what we would come up with as our maximum payment. If we are negotiating this lease, I now know that I need to have a payment of something less than $158,000 in order to avoid meeting this 90% criteria. The way that we do this from a managerial standpoint is we use the 90%. Don't take 89.5 or 89 or 88.5. Use 90%. That's the cutoff point according to US GAAP. And then when you get the solution of $158,065, you know that payments are going to have to be less than $158,000. And so that would enable us to avoid having option number 1 classified as a capital lease. Okay, so that is a very comprehensive lease analysis problem. We've covered a wide variety of issues. We've covered all of the measurement issues related to capital as well as operating leases. We've covered the recognition issues for both types of leases. We've covered the financial statement disclosure issues for both options. And now we've done a little bit of analysis. The typical kinds of analysis that we would be doing would be what happens to pre-tax income, maybe what happens to cash flows, or how are cash flows different between the two options. Hopefully that helps you understand the accounting for leases a little bit better.